140,000 jobs added in a single month were pure statistical ghosts that do not exist in the real world.
That is the bombshell from Danielle DiMartino Booth, a former Federal Reserve insider who warns that the soft landing narrative is a total fantasy built on manipulated data.
Booth is just the start. We are also distilling high-stakes warnings from analysts Matt deWolf and Nick Gerli on the tech bubble and the housing correction.
We have used AI to compress over 5 hours of complex financial deep dives into these rapid-fire, actionable summaries to save you time.
Stick around to find out which tech giant faces a 10% price swing tonight and why the housing market is hitting its lowest point since 2007. Today we're dissecting a bombshell analysis from Danielle DiMartino Booth, a former Federal Reserve insider who says the economic data we're seeing is basically a work of fiction.
Danielle has been sounding the alarm on how the Bureau of Labor Statistics uses seasonal adjustments to mask a much uglier reality in the job market.
Wait, former Fed insider? So she actually knows how they cook the books?
Exactly. She's seen the machinery from the inside, and she says the soft landing narrative is a total fantasy.
Danielle's main point is that the headline numbers are being propped up by models that don't reflect the current high interest rate environment.
So, you're saying the numbers are fake, like a movie prop, or just wrong?
More like statistically manipulated. But the alpha here is that while the official report looks great, Danielle says a massive revision is coming that could tank the markets.
And we'll get into exactly why she thinks the Fed is walking into a trap of its own making in a moment.
Danielle DiMartino Booth points out that in a single recent report, seasonal adjustments added 140,000 jobs that don't actually exist in the real world.
It's called the birth-death model. It assumes a certain number of new businesses are starting up, even when the economy is actually cooling down.
Hold on, 140,000? That's not a rounding error, that's a whole city of people.
Precisely. Danielle argues that this model is broken because it doesn't account for the current surge in business bankruptcies.
So the government is basically assuming growth that isn't happening because the computer says that's what usually happens in April.
That sounds like wishful thinking with a spreadsheet.
Danielle emphasizes that we should look at WARN Act notices, the legal filings companies must make before mass layoffs, which are currently surging.
The government data lags by months, but these state-level filings show that large corporations are cutting staff at a rate we haven't seen since the last major crash.
Wait, if companies are filing these notices now, why aren't the jobs added numbers going down?
Because it takes time for those people to actually leave the payroll and show up in the surveys. Danielle says we're seeing the calm before the storm.
So the official data is looking at the rearview mirror, while Danielle is looking at the road ahead.
And the road looks like it's missing a bridge.
Another red flag from Danielle. The economy has lost 1.3 million full-time jobs over the last 12 months.
Right? And those are being replaced by part-time positions. On paper, the job count looks stable, but the quality of employment is cratering.
Wait, so someone losing a high-paying career and taking 2 part-time gigs looks like job growth to the government?
Bingo. One person, 2 part-time jobs, and suddenly the data says we added a job, even though that person is making half the money.
Danielle argues this is why consumer spending is starting to crack. People can't pay a mortgage on gig economy wages.
That's not a soft landing, that's just a slow-motion crash.
Danielle points to the yield curve being inverted for over 500 days. That's a historic record, right?
It is. Usually when the yield curve stays inverted this long, a deep recession is unavoidable. But the Fed is waiting for clearer data.
500 days? If my check engine light was on for 500 days, I think the car would be on fire by now.
That's Danielle's exact frustration. She thinks the Fed is ignoring the smoke because their favorite data models say everything is fine.
She believes the Fed has already waited too long to pivot, and now they're just watching the clock.
Great. So the pilot is asleep at the wheel while we're flying through a storm.
So what's the endgame here? Danielle predicts we are going to see massive downward revisions to both GDP and employment figures soon.
She expects that when the benchmark revisions hit, we'll find out the economy was actually in a technical recession months ago.
Wait, so we could be in a recession right now and just not know it because the fake data is still being used?
That is exactly what Danielle DiMartino Booth is saying. The reality will hit all at once.
And when that happens, the Fed will be forced to panic cut rates, which usually happens when things are already breaking.
So basically, the oops moment is going to be very, very expensive.
Danielle isn't buying the soft landing talk. She's predicting a hard landing because credit is drying up for small businesses.
Exactly. High interest rates are finally trickling down, and small companies that can't refinance their debt are going to start folding.
Small businesses? But they're the ones who hire most of the people, right?
Correct. And Danielle points out that if they stop hiring and start firing, the consumption engine of the U.S. economy stops cold.
Her prediction, a significant spike in the unemployment rate by the end of the year.
Well, that's a cheerful outlook for the holidays.
If you want to stay ahead of the curve, Danielle suggests monitoring state-level WARN Act notices instead of waiting for the national jobs report.
It's the best way to see where the layoffs are actually happening in real time.
So I should be checking my state's labor website, not the fancy news charts.
If you want the truth, yes, that's the signal Danielle says to follow. Danielle also suggests being cautious with illiquid investments right now as the fake data starts to correct.
When the narrative shifts from soft landing to recession, liquidity becomes king. You don't want to be stuck in a house you can't sell or a private equity fund that's locked.
So basically, keep your exit strategy ready.
Exactly. According to Danielle, the market is currently priced for perfection, but the data is far from it.
Got it. Trust the WARN Act, not the government spreadsheets. That's a real wake-up call.
Matt deWolf is tracking a massive surge in semiconductors this morning, specifically NVIDIA, breaking past $480.
The alpha here is clear. Tech is leading the charge, while the ceasefire extension in the Middle East provides a necessary breather for the bulls.
Hold on, 480. Didn't NVIDIA just hit 450 last week? That is a huge move.
It is, and Matt notes that if semiconductors keep this pace, the entire S&P 500 could be looking at a multi-week high.
But don't get too comfortable. Matt deWolf is also flagging the Tesla earnings call tonight as a massive binary event for the Nasdaq.
Wait, so the semiconductor rally could get wiped out if Elon says something the market doesn't like.
Exactly. Matt's analysis suggests that Tesla is the wild card that could either cement this rally or derail it completely.
We'll dive into those specific price levels for Tesla in a bit, but first, we need to look at the broader market setup.
According to Matt deWolf, the thesis is simple. The combination of semiconductor strength and geopolitical relief is the engine behind this morning's gap up.
Right, the ceasefire extension is taking the immediate risk-off pressure off the table, allowing investors to focus back on AI and earnings.
So basically, peace is good for my portfolio, but microchips are even better.
That's one way to put it. Matt highlights that NVIDIA is the clear leader, but the entire sector is following suit.
It's a textbook risk-on environment, at least for the next few hours. Matt deWolf is eyeing $475 as the line in the sand for NVIDIA today.
He argues that as long as we're above that, the target remains the psychological $500 mark.
Wait, what happens if it dips below 475? Do we panic?
Matt says that would be a failed breakout signal, potentially sending it back down to 460.
So keep a close watch on that 475 level. It's the pivot for the entire tech sector right now.
Matt deWolf's discussion on Tesla highlights that the options market is pricing in a massive 10% move after earnings.
10%? That's almost $50 billion in market cap swinging in a single night.
Seriously. So my Tesla shares could be 10% cheaper tomorrow morning, just like that.
Or 10% more expensive. Matt notes that the key is the guidance on margins and the Cybertruck delivery timeline.
He's watching $210 on the downside and $240 on the upside as the immediate reaction zones. Looking at the broader market, Matt deWolf sees the SPY targeting $458.
He's basing this on the strong consolidation we saw late yesterday, followed by this morning's gap.
Is 458 like a big resistance level or something?
It's the next major supply zone from the summer highs. If we clear it, Matt thinks we could see a run to all-time highs.
But again, that depends on tech and Tesla holding up their end of the bargain. Matt deWolf predicts that big tech will continue to outperform small caps, specifically the IWM, for the remainder of the week.
His reasoning is that interest rate uncertainty still plagues smaller companies, while the mega caps have the balance sheets to weather the storm.
So I should stick with the giants and ignore the little guys for now?
According to Matt's analysis, yes. The relative strength is clearly in the Nasdaq and the semiconductors.
It's a flight to quality play, even if it feels like we're buying at the top. Matt also sees the VIX dropping below 13 if the ceasefire extension holds through the weekend.
That would mean a complete collapse in fear, which historically leads to a slow, steady melt-up in stocks.
Wait, 13? Isn't that like historically low? Are people really that calm?
They are for now. Matt's data shows hedging demand is falling off a cliff.
Complacency can be a trap, though. Keep your stops tight. Matt deWolf's final takeaway. Keep your eyes glued to NVIDIA at $480 and the Tesla reaction tonight.
If NVIDIA holds 480, you can stay long. If Tesla misses big, consider hedging your tech exposure.
So basically, if Tesla crashes, I should probably look for the exit on my tech ETFs.
That's the cautious move Matt suggests. Don't let a good morning turn into a bad week.
The levels are set. Now we just watch the tape.
Nick Gerli just dropped a bombshell on the Las Vegas housing market, and it's not looking good. Sales are literally at their lowest point since the 2007 crash.
It's wild. Nick points out that the volume of transactions has completely cratered, making this the worst environment for sellers in 17 years.
Wait, 2007? Are we talking Great Recession vibes here? Because that sounds terrifying.
In terms of sales velocity, yes. Nick's data shows the buyers have basically vanished into the desert.
And while Vegas is the canary in the coal mine, Nick hints that a second major city is seeing even worse inventory spikes, which we'll get to in a bit. Nick Gerli's main thesis is that a massive supply shock is hitting. Inventory is up 150% year over year.
Exactly. When sales drop and inventory triples, you get a massive downward pressure on prices. It's basic math.
Hold on, 150%? Does that mean there are 3 times as many houses just sitting there?
Basically, Nick explains that the lock-in effect is finally breaking as builders and investors get desperate to move units.
And with more supply than demand, the bidding war era is officially dead.
One of Nick Gerli's biggest concerns is the investor concentration. They own 30% of the market in Vegas.
Right? And Nick notes that these aren't just families, these are institutions and flippers who don't have an emotional tie to the house.
Wait, so if things get bad, they just dump the houses and run?
That's the fear. If they see prices slipping, the sell button is a lot easier to hit than it is for a family with kids in school.
Nick highlights that this institutional exit could turn a correction into a full-blown rout.
Sellers are panicking. Nick's research shows that 40% of active listings in Las Vegas have already seen price cuts.
And it's not just small $5,000 drops. These are substantial cuts because homes are sitting on the market for months.
40%? That's almost half the houses on the market. Are people just overpricing them to begin with?
Maybe, but Nick argues it's a lack of affordability. With rates where they are, the buyer pool is just too small for the current prices.
It's a standoff, and Nick thinks the sellers are the ones who are going to blink first.
Even the builders are running for the hills. Nick mentions that new construction permits have plummeted by 25%.
They see the writing on the wall. Why build more when the stuff you already finished isn't selling?
So if they stop building, wouldn't that fix the supply problem and keep prices high?
Nick says no, because the existing inventory is already so high, the damage is done.
It just shows how pessimistic the professionals are about the next 18 months. So, the million-dollar question, how low do we go? Nick Gerli is predicting a 15 to 20% correction.
And that's just the average. Some of the overbuilt exurbs could see much deeper cuts than that.
20%? My neighbor would lose like $100,000 at that rate. That's insane.
It is, but Nick points out that prices are still way above the pre-pandemic trend. This is just gravity taking hold.
Essentially, the Vegas premium is getting wiped out by reality. Nick doesn't see a quick fix here. He expects demand to stay suppressed well into 2025 because of interest rates.
Right. Unless rates drop to 5%, most buyers are staying on the sidelines.
So we're just in for a long, slow grind downward. No quick bounce back.
According to Nick's analysis, the V-shaped recovery is off the table. This is a structural shift.
It's a waiting game now, and the buyers have all the leverage. Nick's top advice for anyone watching this market is to track inventory levels through sites like Alto's Research.
If you see inventory keep climbing while prices stay flat, you know the big drop is still coming.
So I should be a data nerd before I even think about talking to a realtor.
Absolutely. Nick's whole point is that the data tells the story months before the headlines do.
Don't trust the now is a great time to buy pitch. Trust the numbers. Nick also suggests looking for builder incentives. They're often hiding price cuts by offering rate buydowns.
Exactly. If a builder is offering a 4% mortgage, they're desperate.
Wait, they can do that? They just pay my interest for me?
They're doing anything to avoid lowering the sticker price on the home. Nick says that's your signal to negotiate hard.
In short, if you're a buyer, stay patient. Nick's data suggests the best deals are still months away. Today, we're dissecting the latest market outlook from Chris Vermeulen, the founder of the Technical Traders.
Chris is seeing a broad market rally that's currently in full swing, but he's got some specific warnings about where we are in the cycle.
Wait, so when you say broad rally, does that mean everything is going up at once?
Exactly, but Chris notes that the S&P 500 and the Nasdaq are leading the charge, while other sectors try to keep up.
Look, everyone loves a green screen, but Chris says the real trick is knowing when the music stops. Chris Vermeulen's main thesis is that we are firmly in a stage 2 bullish phase for the S&P 500 and the Nasdaq.
Right, and he points out that the QQQ and SPY are hitting key breakout levels as we speak.
Hold on, stage 2? What happened to stage 1? Did I miss the memo?
Stage 1 is the bottoming process. Stage 2 is the markup phase where the big money is made as trends accelerate.
And while everyone is chasing tech, Chris warns that we might be nearing the excess part of that phase soon.
So we're in the sweet spot, but also near the edge. That sounds stressful.
Chris notes that sentiment is shifting toward extreme optimism, which usually signals we're entering an excess phase of the rally.
He's seeing high-volume breakouts, but says these often precede a sharp blow-off top before a correction.
A blow-off top? Is that as painful as it sounds for my retirement account?
Only if you don't have an exit strategy. Chris explains that this is when the rally gets vertical and then suddenly snaps.
It's the ultimate FOMO trap, and Chris's data shows it's brewing.
Interestingly, Chris Vermeulen is watching gold and silver closely. They aren't following the standard risk-on script right now.
He notes gold specifically is sitting at a major resistance level, essentially waiting for the stock market to blink.
Wait, why do we care about gold if stocks are going to the moon?
Because gold is the canary in the coal mine. If it starts to spike while stocks wobble, the rally is over.
Chris calls it a defensive divergence. It's basically the market's insurance policy.
So gold is like the guy standing by the exit door, just in case?
Chris also points out a gap in the rally. The Russell 2000, or the IWM, isn't showing the same strength as tech.
Yeah, small caps are struggling to break their own resistance, which Chris says suggests this isn't a healthy, broad-based rally yet.
Is that bad? I thought we liked tech anyway.
It means the foundation is narrow. If only 5 stocks are carrying the market, it's a lot easier for the whole thing to tip over.
Precisely. Chris wants to see the small guys join the party before he's fully convinced of the rally's longevity. Chris predicts there might be another 5 to 8% upside in the short term before we hit a significant ceiling.
He's targeting a specific level on the SPY where he expects the excess phase to finally run out of steam.
8% sounds like a lot. Can I just buy now and sell in a week?
You could, but Chris warns that the higher it goes, the more violent the eventual pullback will be.
It's a game of musical chairs now. Chris says the goal is to be near the door when the music stops. Once we hit that top, Chris is forecasting a potential correction of 10 to 15%.
His reasoning is based on historical stage 3 patterns, where the market flattens out before a sharp drop to retest moving averages.
Wait, 15%? That wipes out all the gains we just talked about.
That's why Chris emphasizes technical exits. You don't want to ride the elevator all the way down.
It's about keeping what you made during the stage 2 run. Chris Vermeulen recommends keeping a close eye on the 20-day and 50-day moving averages.
Right. If the price closes below those levels on high volume, Chris says that's your cue to exit or move to cash.
So the lines on the chart are basically my get out now signs.
Exactly. They act as the floor. If the floor breaks, you don't want to be in the building.
Better to leave the party early than to be the one cleaning up the mess. Today we're dissecting a heavy conversation between Jeff Snider and Mark Moss about why the global economy is already in the worst-case scenario.
Mark Moss's core take is that the everything bubble is finally meeting its match in a broken Eurodollar system.
Wait, Eurodollar? Like dollars in Europe? Why should I care about that?
It's the plumbing for the whole world's credit. Mark explains that when this system breaks, credit disappears and the economy stops breathing.
Jeff Snider points out that for the first time in 50 years, bank credit growth has actually turned negative.
That's huge. Usually credit expands forever. When it shrinks, businesses die and markets tumble.
So wait, if credit is shrinking, does that mean it's harder for me to get a car loan or a mortgage?
Exactly. And while we're on the subject of pain, Mark mentions a specific asset class that's about to be pulverized, which we'll get to in a minute. Yet Mark Moss highlights a terrifying milestone. U.S. interest payments on debt have hit $1.1 trillion.
To put that in perspective, we're spending more on interest than we are on our entire national defense budget. But
hold on, 1.1 trillion? Just on interest? We aren't even paying off the actual debt yet.
Nope, that's just the minimum payment on the credit card. Jeff Snider argues this is a mathematical dead end.
Jeff Snider explains that even if the Fed drops rates, banks aren't lending because they're terrified of risk.
Right? Mark Moss calls this a liquidity black hole. The money is there, but it's not moving into the real economy.
So the banks are basically hoarding cash while everyone else struggles.
Basically. If they don't trust the person they're lending to, they'd rather sit on it, even if rates are low.
Mark also mentions the massive $1.5 trillion wall of commercial real estate debt coming due by 2025.
Most of those office buildings are empty or losing value. How do they refinance that?
Wait, if they can't pay back those trillions, what happens to the banks that lent it?
That's the worst case scenario Jeff was talking about. It's a slow motion car crash for the banking sector.
Jeff Snider's main point is that the Eurodollar market is unregulated and opaque. No one knows the true scale of the risk.
It's ghost money. Mark agrees that when the offshore dollar system freezes, the domestic system follows suit.
Ghost money? That sounds like something out of a horror movie.
It is a horror movie if you're an investor. If the plumbing is clogged, the whole house floods. Mark Moss predicts we'll see a forced liquidation where people have to sell whatever they can just to get cash.
When credit disappears, cash becomes king, briefly, before people realize the cash itself is being devalued.
So everything goes on sale? Like a stock market Black Friday?
Except nobody has the money to buy the deals. That's the catch.
But Mark isn't all gloom. He thinks assets outside the system, like Bitcoin and gold, will eventually decouple.
Jeff Snider is more cautious, but Mark believes that when the debt cycle ends, people will run toward hard assets.
So if the bank system is a dumpster fire, gold is the fire extinguisher.
That's the theory. Mark's bet is that the Great Reset will force a shift to decentralized money. Jeff Snider's takeaway is to watch the yield curve and the TED spread to see when banks are truly panicking.
If those signals spike, it means the plumbing is officially broken.
Okay, so keep an eye on the charts and maybe don't keep every penny in a small regional bank.
Exactly. Mark Moss's final word, be your own central bank. Diversify into assets that don't depend on someone else's credit. The big takeaway from Adam Taggart's talk with Chance Finucane is that we aren't looking at a simple soft landing. Stagflation is actually the main event now.
Exactly. Chance, the chief investment officer at Oxbow Advisors, argues that while everyone is obsessed with a recession, the real pain comes from stagnant growth paired with inflation that just won't die.
Wait, so stagflation is like the worst of both worlds? No growth, but everything still gets more expensive?
Pretty much. It's the economic equivalent of being stuck in traffic while your gas tank leaks.
Chance has a massive amount of experience managing portfolios through these cycles, and he's telling Adam Taggart that the current market optimism might be misplaced.
Is he saying we should all be panicking, or just that we need a better plan?
He's leaning towards a better plan. He thinks the S&P 500 is way too top-heavy right now.
We'll get into his specific defensive moves in a second, but let's just say his outlook for the rest of the year is cautious, to put it mildly.
Chance Finucane isn't buying the soft landing hype that the media is pushing.
He told Adam Taggart that the lag effect of interest rates is finally catching up with us and it's starting to bite the consumer.
Lag effect? You mean like when I order a pizza and it takes an hour to show up, but for the whole economy?
Actually, yes. The Fed raised rates months ago, but we're only just now seeing the impact on credit card debt and car loans.
And with interest payments on national debt hitting $1 trillion, the government doesn't have much room to maneuver.
$1 trillion in interest. That's not even the debt itself, just the interest.
Chance points out that the S&P 500 is currently one of the most concentrated markets we've seen in decades.
Right? The top 10 stocks are basically carrying the entire index on their backs, while the average stock is struggling.
So if those 10 companies have a bad day, the whole market tanks.
That's exactly the risk. Chance calls it a thin market, which is usually a sign of weakness, not strength.
It's like a house held up by 2 or 3 very tired pillars.
I don't like the sound of that house.
The data Chance Finucane shared is staggering. The U.S. is now paying $1 trillion just in interest on its debt.
That's more than we spend on the entire defense budget. It's a massive drag on future growth.
Wait, so we're spending more on interest than on our actual military?
Correct. And as those interest rates stay higher for longer, that number is only going to climb.
Chance argues this is why the Fed is in a corner. They can't easily cut rates without reigniting inflation.
So they're basically stuck between a rock and a very expensive hard place.
Chance also discussed how corporate margins are being squeezed by labor costs.
Even if revenues look okay, the cost to generate that dollar is going up, which means less profit for shareholders.
So companies are working harder just to make the same amount of money.
Exactly. And when profits stall, stock prices usually follow suit eventually.
Especially when the valuation is as high as it is right now. There's no margin for error.
So if they miss their targets by even a little bit, it's a bloodbath.
Looking forward, Chance Finucane predicts that the days of double-digit returns are over for a while.
He's calling for low single-digit returns. We're talking maybe 3 to 5%, if we're lucky.
3%? My high-yield savings account does better than that right now.
That's his point. Why take the risk of the stock market if you can get 5% in cash?
It's a massive shift in how people need to allocate their money. Chance says cash is no longer trash.
I like cash. Cash is safe.
Chance also expects inflation to stay sticky, likely hovering around 3 or 4% rather than dropping to the Fed's target of 2%.
This last mile of inflation is the hardest to beat because of structural issues in housing and labor.
So my groceries are never going back to 2019 prices, are they?
Chance doesn't think so. He sees a long-term shift toward a higher cost environment.
Which means your investment strategy has to change to keep up with that loss of purchasing power.
Great. So I have to run faster just to stay in the same place.
So what do we actually do with this info? Chance suggests keeping a very close eye on the 10-year Treasury yield.
If that yield stays high or climbs, it puts immense pressure on stock valuations. It's the gravity of the financial world.
So if I see the 10-year yield going up on the news, I should check my portfolio.
Exactly. It's the signal Chance uses to gauge how much pain the market can take.
Chance's main advice to Adam Taggart was to focus on quality, companies with real earnings and zero to low debt.
No debt in this economy? Do those even exist?
They do. And they're the ones that will survive a stagflationary environment.
The companies that rely on cheap credit to survive are the ones Chance says to avoid like the plague.
Got it. Strong balance sheets are the new cool.
In a world of stagflation, they're the only cool that matters. So, let's dive into the key theses from our experts. Starting with Danielle DiMartino Booth, she argues that the so-called soft landing is just a myth.
Absolutely. Danielle highlights that the data we see is adjusted and doesn't reflect the true chaos in the job market.
Wait, so we're not dealing with a recovery, but rather a fabrication? Yikes.
Pretty much. It's a wake-up call for anyone relying on those numbers. Next up is Mark Moss, who believes we are witnessing the end of the global debt cycle.
That's right. Mark argues this could trigger severe economic disruptions as debt levels are unsustainable.
So what's coming next? A financial apocalypse?
Not necessarily, but more volatility is certainly on the horizon. Then we have Chris Vermeulen, who's quite the optimist amidst all this turmoil.
Exactly. He sees the market rally as a reflection of changing investor sentiment rather than fundamental shifts.
Oh great, so if I catch the optimism bug, I'm good to go?
But it's crucial to stay cautious because sentiment can change quickly.
Nick Gerli delivers a stark warning about an impending housing market correction due to excess inventory.
He emphasizes that this could lead to dramatic price drops.
So am I buying a house or renting my entire life?
Nick suggests thinking twice about jumping into the market right now. And finally, Matt deWolf stresses the significance of the semiconductor industry in shaping economic relations.
He argues that future geopolitical shifts will revolve around technology and chips.
So is my next phone going to explode because of geopolitics?
Hopefully not, but those dynamics will definitely affect tech prices. Interestingly, across the board, all guests express skepticism about the current recovery.
Right? They each highlight how various aspects, from job data to debt cycles and market psychology, signal underlying issues.
So, we're all just one bad report away from panic.
Essentially, they all seem to feel the ground is shaky under our feet. Both Mark and Nick point out that ongoing unhealthy economic behaviors could lead to catastrophic outcomes.
Exactly. Mark talks about the debt cycle while Nick warns about housing over inventory.
So, they both agree we're running out of road with this reckless driving.
You nailed it. They each warn that ignoring these signs will cost us. Danielle and Matt also underscore the influence of geopolitics on our economy.
Yeah, Danielle links it to job data, while Matt points to the semiconductor troubles.
So they agree it's not just about economics, it's also politics, shaking things up.
Exactly. The two realms are intertwined more than ever. Now on to the disagreements. Danielle is forecasting a near-term crisis, while Mark thinks we're on a slower decline.
That's right. Danielle's belief is that we're about to hit a wall, while Mark sees the decline as slow-moving.
So one says next month is catastrophic, and the other says, don't worry, it'll take years.
Pretty much, a big-time divide in urgency. Chris is quite bullish on the market rally, while Danielle argues it's just a mirage.
Correct. Chris believes confidence will keep pushing markets up, but Danielle warns it's misleading.
So we're either in for a surprise party, or a rude awakening.
That's a great way to frame it. Nick highlights inventory surpluses leading to a crash, while Matt talks about geopolitical tech impacts.
They both paint different pictures. Nick's worried about homes, while Matt's concerned about chips.
So it's like a duel over what's going to sink the ship first.
Exactly. Both issues need attention, but for different reasons. If today's breakdown helped clarify these complex insights, hit that like button and subscribe for more.
We're here to distill the best analytical content so you can focus on what matters most.
Honestly, I learned so much in just a few minutes. I'm 100% subscribing.
Thanks for joining us, and stay tuned for our next discussion. Trust me, you don't want to miss it.